Okay, over the last couple of weeks, we studied about electronic cash. Okay, banking services related to bank. We discussed about services related to banking services, and in the last week, we discussed about services related to electronic cash. So, with respect to services related to electronic cash, the most important thing is uh, the cards, electronic cards. Okay, so we discuss about services related to electronic cash. We discuss about different types of cards: credit card, debit card, automated teller machine cards, and we learned about what else? Credit cards we learned, and then we learned about debit cards. Okay, we learned about debit cards. Then we learned about ATM cards, and we learned about the importance of services related to electronic cash, instantaneous minimum risk, recording information automatically, and ability to transact at any time of the day. And we also learned about the limitations, risks of being data being destroyed, risk of being exposed to a new type of electronic frauds, and incurring extra costs and inability to use payments at a certain shops. And today we are going to learn about insurance services. So now many of us, we have some form of experience with the insurance. Most of the time when you pass, maybe most of the time after your student life, or even during the student life, you all get some health insurance. Okay, sometimes when you deposit money in children's savings accounts, you automatically get insurance. Okay, sometimes you have your family insurance, health insurance, life insurance, vehicle insurance. Likewise, we all have different types of insurances. What insurance does is, insurance makes sure your risk is being reduced to a certain level. In life, we all face risk, be it in our health, be it in our vehicle or transportation related things, be it in our life, we all have risks. So we want some cushion to face risks. That is why we have insurance services. So every individual as well as every businessman have to face risks. It is impossible to identify with a certainty when or where those risks will occur. Instant fires, storms, floods, tsunamis, earthquakes, accidents, and riots are such risks. In order to face these risks, systemic methods should be adopted. Insurance institution give systemic methods to minimize these risks. Okay, so as I said, everyone face some risk. Now, the thing with the risk is we don't know with a certainty when it will happen, where it will happen. For example, let's say if we know that a car accident is happening on a particular day at a particular place with a certainty, then we don't need insurance because we know it is happening, so we can simply avoid it. එදාට ඒ ගමන යන්න නැතුව හිටියා නම් ඉවරයි. Okay, end of the story. Now, for example, like let's say things like fires, storms, tsunamis, earthquakes, accidents, and riots, they happen, they could happen at any time. We never know. Okay. Then what we can do from our side is we can have some systematic approach to reduce those risks or to minimize those risks. So what is that systemic approach? That is insurance. Okay, so insurance institutions give systematic method to minimize these risks. Okay, so the basis of insurance is accumulating risk. Okay, what they do is they accumulate risk. For example, what they do is now let's say people are afraid of car accidents. So what they do is they accumulate car accident risk and they insure it. Okay. Insurance collect premiums from individuals who anticipate different risks and pay compensation from that common fund to those individuals who have faced that risk indefinite. Insurance accumulate the risk of all into a single insurance funds. Hence, insurance is known as pool of risks. Okay, it's like this. Now let's say, okay. Now let's say, okay, okay. Okay, now let's say there are 10 individuals. Okay, there are 10 individuals. Okay, there are 10 individuals who face car risk. Okay, car accident. Okay, they have vehicle risk. Okay, they have vehicle related risk. Now, what happens is, now there is this insurance company. Okay, there is insurance company. What they do is they pool this risk. Okay, they pool this risk and they take a small premium out of them. Okay, now let's say if a accident happen, okay, accident happen, let's say now there are 10 people. Now they do some form of calculations in the insurances. Okay, now they take everything into factor and they calculate, okay, there are 10 people. Out of this 10, there is probability, let's say, there is probability, let's say 20% being uh, 20% facing car accidents. Okay, and that is, let's say that is that 20%, it will require a fund of 2 million for that insurance coverage. Okay, so what they do is they add the premium and they divide it among these 10 people. So each people will have to pay something around, let's say, 20,000. Okay, no, not 20,000, 200,000. Likewise, they accumulate the risk, and they distribute among the group of people so they can take a premium. And that premium they accumulate and they invest, and when something goes wrong, they pay it back. Sometimes they take that money and they reinsure it in someplace else. Okay, for example, let's say Sri Lanka Insurance. Sri Lanka Insurance might reinsure themselves with a global insurer. Maybe let's say, I don't know, some insurance company in Europe, they reinsure themselves. Likewise, they accumulate and uh, pool the risk. Okay, so basis of insurance is accumulating risks. The insurance collect premiums from the individuals who anticipate different risks and pay compensation for that common fund to those individuals who have faced these risks indefinite. එතකොට ඒ කියන්නේ risk එක හම්බුන කෙනාට pay කරනවා. Insurance accumulate the risk of all into a single insurance funds. Hence, the insurance is known as pool of risks. Okay. Insurance services. Insurance is established to share financial losses among the participating individuals of that insurance fund. Of one or few individuals who have borne a risk with the difficulty. එතකොට මොකක්ද වෙන්නේ ඇත්තටම? ඉන්ෂුරන්ස් එකදී කරන්නේ අපි ඒ පාටිසිපන්ස්ලා අතර රිස්ක් එක ෆයිනෑන්ෂියල් ලොස් එක ෂෙයා කරන එක තමයි වෙන්නේ. මම හිතනවා මට මොකක් හරි හානියක් වෙයි කියලා. ඒ හින්දා මම ඉන්ෂුරන්ස් එකක් ගන්නවා. මං වගේම හිතන අය තව අපි හිතමු 10 දෙනෙක් ඉන්නවා. ඕකේ, ඒ 10 දෙනාගේම ප්‍රීමියම් එක අරගෙන ඉවර වෙලා අපි ඉන්ෂුරන්ස් ෆන්ඩ් එකක් හදා ගන්නවා. නමුත් ඇත්තටම වෙන්නේ අපි හිතන්න අපි කොයි වෙලාවකදීවත් it is I mean 10 දිනාටම ওই ප්‍රශ්නේ නැහැනේ. එතකොට ওই ප්‍රශ්න සමහරකට එන්නේ මොකක් හරි ප්‍රශ්නයක් එන්නේ එක්කෙනෙක්ට වෙන්න පුළුවන්. ඒ එක්කෙනාට එතකොට මොකද කරන්නේ? අර එකතු කරගත්ත ෆන්ඩ් එකෙන් පූල් එකෙන් අර එක්කෙනාට ගෙවනවා. They are paying to that one person. Now let's say what is happening is there could be 10 persons who think a vehicle accident will happen. Okay, so what they do is they pay a insurance premium. Okay, but actually in real life scenario, what happens is not everyone will face that car accident. No, only one or two people will face, but we don't know whether I will face it or somebody else will face it. Okay, so because I'm scared, I take the insurance. So insurance, what they do is they accumulate the money and they invest the money. Okay, or else they reinsure. So something goes wrong, then they will pay it back. Okay, they will pay it back. That is sharing financial losses among participating individuals. There could be 10 people. If two people meet the accident, then that financial loss will be, that two persons financial losses will be shared among that 10 persons, but they don't know whether, I mean, who will face that risk. It could be the first person, second person, third person, or fourth person, we don't know, or the 10th person. Since we don't know, we insure ourselves. Okay. Insurance is a pool of risk where the losses of one party are shared collectively. So as I said, that loss of one party is shared collectively. This is an agreement between two parties. And what are these parties? What are the parties involved for insurance? That is an important thing. Okay. First party, the party who obtains the insurance coverage, that is the insured. First party ka who is first party? The person who is taking the insurance. The second party, the party who provides the insurance. For example, the insurer. Okay, insurer is an insurance company. What are the insurance companies? For example, Sri Lanka Insurance, Selinco Insurance, I think Fairfirst Insurance, Union Assurance. Likewise, the SoftLogic Insurance. Likewise, there are different insurers. And then third party, all the other parties and the property that will be affected by an insurance contract. Okay, the parties who are not the first party and second party, as well as the things that are being affected by the insurance contract are the third party. For example, passengers and other vehicles on road will become the third party when a vehicle is insured. Now let's say a vehicle insurance. In a vehicle insurance, there are three parties: first party, second party, and third party. First party is the person who is taking the insurance. For example, I am taking a car insurance for my car. Okay. Second party is the insurance company. Second party is insurance company. Insurance company simply, it could be any company that I told you: Sri Lanka Insurance, SoftLogic, I don't know, Fairfirst, Selinco. Likewise, there are thousands and thousands of, not thousands actually, but there are like, let's say maybe around 10, 15 insurance companies in Sri Lanka. Okay. Then the third party, let's say I go and suddenly I knock another, let's say I knock some car, then that car and that passengers in that accident, they are the third party. Okay, so there are three parties: first party, second party, and third party. Okay, so we can write the note. I will read this out so you can write it. Limitations of services related to electronic. Sorry. This is something. Okay, 1 second. What's this? Insurance services. Okay. Insurance services. Every individual as well as every businessman has to face risks. It is impossible to identify with a certainty when or where those risks would occur. Instant fires, storms, floods, and two tsunamis, earthquakes, accidents, and riots are some such risks. In order to face to these risks, a systemic method should be adopted. Insurance institution will give systematic method to minimize these risks. The basis of insurance is accumulating risk. The insurance collect premiums from individuals who anticipate different risks and pay compensation from that common fund to those individuals who have faced these risks indefinite. Insurance accumulate the risk of all into a single insurance funds. Hence, insurance is known as pool of risks. Insurance is established to share financial losses among the participating individuals of that insurance fund. Of one or few individuals who have won a risk with a difficulty. Insurance is a pool of risk where losses of one party are shared collectively. This is an agreement between two parties. So parties involved in insurance are first party, second party, and third party. The parties who obtain the insurance coverage, that is the insured one. The party who provides the insurance coverage, that is the insurer. and all other parties and properties that are affected by the insurance contract, that is the third party. So take couple of minutes and write this down. Okay, now let's look at principles of insurance. Okay, now like many things, insurances are also built on insurance principles. Okay, now there are few principles. Basically, we are learning three principles in our grade 11 syllabus. Okay, insurable interest, utmost good faith, and indemnity. So those are the principles of insurance. Sometimes you might get a MCQ question asking what are the principles of insurance, or what is not a principle of insurance. Then you will be given this three and something else. Okay, then you should know these three are the principles of insurance. Insurable interest. The legal right to obtain an insurance coverage for a life or for a property is known as insurable interest. The legal right to obtain an insurance. The legal right I have to obtain insurance coverage for life or property is known as insurable interest. For example, husband and wife have insurable interest for each other's life. Okay. In property insurance, the legal owner of such property has an insurable interest. A creditor has an insurable interest over the life of the debtor up to a value of the loan. Okay. දැන් උදාහරණයක් විදිහට මෙන්න මේ අන්තිම එකට කියන එක මම කියනවා. What is this? Okay. The last one, I think all others are very familiar. Either husband and wife can take a insurance, okay, for each other's life, okay. Usually, like when you take a life insurance for yourself, it's usually for yourself, okay. Sometimes when you take a life insurance, there are some options where there is some insurance going for family members as well. Okay, but most of the time, if you take insurance for yourself, it's for yourself. Okay. Property insurance, let's say I have a house, okay, and let's say I live in my mother's house, okay. I live in my mother's house. Then actually I don't have a insurable interest over that, because like I do not legally own it. Insurable interest lies with my mother. Okay. And then creditor has the insurable interest over the life of the debtor up to the value of the loan. That means, let's say, let me repeat, a creditor has an insurable interest over the life of the debtor up to the value of the loan. Okay. Now let's say I take a loan from the bank. Okay. Then I take 1 million loan from the bank. I take 1 million loan from the bank. And that for that 1 million, bank has an insurable interest. For that 1 million loan, bank has an insurable interest. I take a loan from the bank for 1 million, and bank has an insurable interest for that 1 million loan. So what they do is they take, sometimes it's called DTA policy, decreasing term assurance, I think. They take a DTA policy. So if something happens to the debtor, that DTA policy will pay off the debt. Most of the time, this insurance policy is there for pensioners, when pensioners take loans. Okay. So insurable interest is the legal right to obtain insurance coverage for a life or for a property is known as insurable interest. Then utmost good faith. Utmost good faith. This principle states that both the parties to the insurance contract should disclose all the relevant information accurately for the contract. All the relevant information. The parties involved in the contract are the insurer and the insured. Insurer is the insurance company, and insurer is the party who has obtained the insurance coverage. If either party does not disclose any important information, it will be a breach of utmost good faith. Then both parties have the legal right to cancel the insurance contract. Now let's say something like this. Now let's say I have some sickness. Let's say I have diabetes, okay, and I'm going to take a insurance. Well, let's say I do not disclose my condition regarding diabetes. Okay, then what happened? I have breached utmost good faith because I have not disclosed my, I am going to take a, let's say, medical and life insurance, and I have diabetes, and I do not say I don't have, I have diabetes. Then it's a breach of utmost good faith because I do not disclose it. Let's say, on the other hand, insurance company is giving a insurance, and they are giving the insurance for everything but not diabetes. Okay, if they do not mention that, let's say they say, okay, I am going to give you an insurance policy which covers your all health, which covers your health problems, and they are giving me that, and somehow they have not disclosed that uh, diabetes is not covered in that, then that is a breach of utmost good faith. Okay, you must disclose all the relevant information accurately for the contract. Okay, you must disclose all the relevant information. Then, indemnity. This principle states that if a loss occurred to an insured property, the compensation paid should be sufficient only to reinstate the damage to the previous state. This principle states that if a loss occurred to an insured property, the compensation paid should be sufficient only to reinstate the damage to the previous state. This principle does not apply for life insurance. Of course, for life insurance, you don't have indemnity. Indemnity can kiyanne. Now, what it says is, now you should be able to restore the damaged property to the previous state. Now let's say there was now let's say there was a let's say there was a house. Okay, let's say there was a house. Okay, and then let's say something all of a sudden happened. Okay, then you must reinstate it to your previous state. Okay, your previous state is this. Okay, you cannot make from the insurance funds, after that you cannot make it this. Now you had a single story house, you take the insurance and you build a two-story house. That is not possible. Okay, it is only to cover up the losses you had initially. I mean, it is only to cover up the losses and reinstate to the first stage. Okay, and the next important thing is, now let's say you insured your car. Okay, your car is worth 2 million and you insured it only for 500,000. Then you can take only 500,000. You cannot take 2 million. You can take only 500,000. Insurance කරපු ගානට විතරයි ගන්න පුළුවන්. You cannot take 2 million. Okay. Okay. Then you can write down this note. I will read it out so you can write it down. Okay. Principles of insurance. Insurance service is built on insurance principles, of which few are mentioned below: insurable interest, utmost good faith, and indemnity. The legal right to obtain insurance coverage for a life or for a property is known as insurable interest. Husband and wife have insurable interest for each other's life. In property insurance, the legal owner of such property has an insurable interest. Okay, legal owner is having the insurable interest. Okay, legal owner of the property. Okay, a creditor has an insurable interest over the life of the debtor up to the value of the loan. Then the second one, utmost good faith. This principle states that both parties to the insurance contract should disclose all the relevant information accurately for the contract. The parties in the contract are the insurer and the insured. The insurer is the insurance company and insured is the party who has obtained insurance coverage. If either party does not disclose any important information, it will be breach of utmost good faith. Then both parties have the legal right to cancel the insurance contract. Okay. Then indemnity. This principle states that if a loss occurred to an insured property, the compensation paid should be sufficient only to reinstate the damage to the previous state. This principle does not apply to the life insurance. For example, when a motor vehicle having a value of rupees 2 million is insured for the same value, a compensation cap a compensation of rupees 500,000 can only be obtained for a damage value rupees 500,000. Now I need to re-explain this example. Okay. One thing I told was the initial thing I told was the underinsurance. That is, you insure your vehicle value is 2 million and you insured it for 500,000, and all of a sudden, if you are to take the insured sum, you can take only up to 500,000. Okay, that is under insurance. Then some insurance companies even do not give that 500,000. Okay, here actually I miscommunicated it initially. Here what it say is you have a motor vehicle value 2 million. Okay, and you have insured it for the 2 million. You have insured it for the 2 million. Now a damage happens and that damage is 500,000. That damage is 500,000. Then you can take compensation only up to that 500,000. You cannot, since you have insured it for 2 million, it doesn't mean that you are going to get 2 million compensation back, because the damage is 500,000 and you are getting the insurance claim only for 500,000. That is that example I explained to you over that housing thing, this thing. Okay, you have a house and something bad happened. So you can get the insurance only to reset it up to this level, okay, this previous level. And you do not get it to make it a two-storied house. Okay. So that's it. So you can start writing the note, principles of insurance, and start writing this. Okay, I was asked to re-explain insurable interest. Okay, let's read it out again. Insurable interest. Insurable interest is the legal right to obtain an insurance coverage for a life or for a property. Okay, it is the legal right to obtain an insurance coverage. So let's say you want to obtain a insurance coverage for something. What should I have? I should have the insurable interest. To have an insurable interest, you should have a ownership of that property. The legal right to obtain the insurance coverage will arise only if you have a legal right for the property. Okay. So insurable interest is the legal right to obtain insurance coverage. So that legal right will come if you own something. Now let's say for a property, you must be the legal owner. For life, it should be your life. Usually you cannot take insurance for someone else's life. Okay. Now let's say you are a bank and then you have given a loan. For that loan, the loan that you have given, that loan is a debtor to you. For the bank, that loan is a debtor. For that loan, bank can take a insurance. Did you understand? Insurable interest means legal right to obtain insurance coverage. You should have a legal right to obtain insurance coverage. For you to have a legal right to obtain insurance coverage, there should be certain things. They are explained through this example. A husband and wife can insure each other's life. For a property insurance, the legal owner of that property only have the insurable interest. For the loans, they can take the insurable interest over the life of the debtor up to the value of the loan. Okay, so that's it. Okay, now we are going to learn about life insurance. So insurance provide vital services for any individual. Okay. If an insured dies prematurely, his dependents can obtain the compensation from the life insurance. Life insurance cover the risk associated with the life of an individual. Life insurance is also termed as life assurance. Life insurance life assurance accidents, health issues, surgeries undergone by individuals, hospital charges can also be included as additional covers into the life insurance contract. So what happens in a life insurance? I take a life insurance, and let's say if I die, uh, like before the like if I die prematurely, what happens is I will receive my life insurance policy. Okay. Then what are the importance of a life insurance? It can be used as a method of saving or investment. The reason I say is, now let's say I take a life insurance, and if I live up to the insured period, okay, then I can take the life insurance maturity uh, amount I can take. If the insurer survived until the policy mature, the insured can obtain the insured value and other benefits. That was what I told. Okay. If the insurer dies prematurely, the named dependents can obtain the compensation, can obtain financial assistance in the case of a marriage and education of children, can be used as the collateral when obtaining loans from the financial institutions. So what are the importance? It can be a saving or investment. So you can take the maturity value if you survive until the policy mature. If you die prematurely, dependents will take the compensation, and they can also obtain financial assistance in case of marriages and education of children. And then sometimes you can keep the life insurance policy as a collateral and take loans. So you can write down the note, put the subheading as life insurance. Insurance provide vital services for individuals. If an insured dies prematurely, his dependents can obtain the compensation from life insurance. Life insurance covers the risk associated with the life of an individual. Life insurance is also termed as life assurance. Accidents, health issues, surgeries undergone by individuals, and hospital charges, etc., can also be included as additional covers into the life insurance contract. So these like compensation for accidents, health issues, surgeries, hospital charges, they are included as additional covers for the life insurance. Okay. Okay, you can take a couple of minutes and write this. We learned about life insurance, and now we are going to learn about property insurance. Okay, so property insurance is the insurance obtained to cover damages that might occur to the property, such as building, machinery, value, and inventory. So life is about your life, but here it's about the properties, the physical things like buildings, machines, vehicles, and inventory. So simply the car insurance that we take is a property insurance. It's a form of a property insurance. Insurance companies issues various types of insurance policies under this insurance. For example, fire insurance, motor insurance, marine insurance, and insurance for natural disasters. So the importance of property insurance. So what are the what is the importance? Cover financial losses arising in an organization from various risks. For example, threat of fire, burglary, horakankarot, occupational hazards, like let's say it burst out, something like that happened. Okay. Facilitate in conducting business operations continuously. Now, the importance of property insurance is, if you have yourself insured, then you are safe. Even something bad happens, you can get the insurance compensation and prevent the massive damages. Since the insurance pay compensation for the massive damages faced by businessmen, it facilitates businesses to be reinstated to previous state and continue the operation. Supports both domestic and foreign trade activities. Marine insurances, goods in transit insurance, export credit insurance, and cash in transit insurance. Now, it's not just the operation locally, but if you are engaged in some foreign trade, let's say you are importing a car from Japan, even for those things, there are some insurance. Okay, there are marine insurance, goods in transit insurance from factory to port, goods in transit, or from Japan to Colombo, likewise. Export credit insurance and cash in transit insurance. So those are the importance. Cover financial losses arising in an organization from various risks, facilitate in conducting business operations continuously, and support in both the domestic and foreign trade activities. Okay, let's write it down. Put the subheading as property insurance. Property insurance is the insurance obtained to cover damages that might occur to the property, such as building, machinery, vehicles, and inventories. Insurance companies issue various types of insurance policies under this insurance. Example, fire insurance, motor insurance, marine insurance, and insurance for natural disasters. Okay, take a couple of minutes and write this. Importance of property insurance. Cover financial losses arising in an organization from various risks. Example, threat of fire, burglary, occupational hazards. Facilitate in conducting business operations continuously. Since the insurance pay compensation for the massive damages faced by businessmen, it faces a business to be reinstated to the previous state and continue the operation. Support both in domestic and foreign trade activities. Marine insurance, goods in transit insurance. These are the examples, and export credit insurance and cash in transit insurance. Okay. Okay, take a couple of minutes and write this. Okay, now we are going to learn about differences between the life insurance and property insurance. So we learned about two forms. One is life insurance, the second being property insurance. Now, what are the differences? The value of the policy depends on the risk of the life and insured's ability to pay life insurance. Okay. Then in property insurance, the value of the property depends on the monetary value of the property. Property insurance, it is about the monetary value of the property. But in a life insurance, it's insured person's ability to pay as well as its risk of life. Let's say president is going for a life insurance, then that could be very it is a bigger policy. I mean, the risk involved is very high. So for someone like us, it's not much of a risk. Okay, life insurance. Since the damage to the life cannot be reinstated, the principle of indemnity does not apply. Okay. The principle of indemnity it should be able to reinstate to the original level before the losses. But if someone dies, can you do anything about it? No, you cannot. Okay. Since the compensation can be paid only to reinstate the property, the principles of indemnity does apply. Okay. Since the compensation can be paid only to reinstate property, then the principle of indemnity can apply. Let's say property value is 5 million. It's insured for 5 million, and 2 million worth loss happened. Then that 2 million can be reinstated and take as a compensation. Life insurance. Benefits such as bonuses, interest, etc. will be received in addition to the insured value. The life insurance bonus insurance interest likewise, there are additional benefits in a life insurance. But in a property insurance, you are not entitled for such additional benefits. Okay, you don't have bonuses. Do we get bonuses when we take a car insurance? No, we don't. Okay, so we don't have benefits like that. Okay, then let's write down the note, put the subheading as differences between life insurance and property insurance, and write out this table. And with that, we will be concluding today's session.